Now, South Africa's Imperial's holding has acquired a 49% stake in the logistic unit of UAC for $26 million. The transaction gives the Imperial Group entry into the logistics sector of the fast-growing Nigerian FMCG, telecommunications and pharmaceutical industries. MDS, the logistic business of UAC, grew profits by 131% in 2012 and is a key contributor to the improving fortunes of the group. Now, I earlier spoke to the CEO of UAC, Larietta, to get more on the deal and on the company's first quarter results. Take a look.
Well, it's in line with our strategy, which is to find partners, international partners for key verticals of our business. Remember, we had one with Tiger on our UAC Foods Limited side. So today we are actually announcing the one regarding logistics, which is FDS Logistics. We are happy that we've got a partner in Imperial, a partner that is operating across 18 countries in Africa, a partner that has over 40 years of logistics experience, a global leader in logistics and supply chain management solutions. So that's what we're announcing regarding.
Can you give us some insight into the numbers for these deals, though? What's the value of the equity that they are taking? They will be taking a 49% stake in MDS Logistics.
Correct. Yeah, that would be about $26 million for that 49% equity stake.
All right. Okay. And so, what does this mean for MDS? What's next for MDS, given this? I'll come back to the Tiger brand partnership and what to expect going forward on that. But what can we expect in the short term with this transaction?
I think for MDS, it means here we are in a situation where we have the right partner who has warehouse management system experience, who has transport management system experience, who has significant knowledge about how logistics globally is played, and partnering with the MDS with its own local knowledge, and then we'll be able to unlock the potentials that we see in the logistics market. Remember, today in Nigeria, for instance, we're talking a lot about the kind of growth we expect to see the FMCG category. For that growth to happen, it also means that the route to market would underpin that growth, and it is logistics service providers like MDS that will provide that route to market. So the growth that will come from FMCG, the growth that will come from the pharma sector, the growth that will continue to come from the telecom sector, must of necessity be underpinned by route to market solution providers like MDS. So MDS is now going to be partnering with a global leader in that regard, and certainly continue to maintain its dominant leading position in that space.
Of course, MDS reported 131% growth in profits last year. What can we anticipate this year, given this partnership?
I think you can safely say that MDS growth would be something in multiples of the growth of GDP of this country. We would like to think that we should be growing between 15 and 20% year on year going forward in MDS. Yes.
All right. And let's talk a bit about the Tiger Brands partnership. And I think a lot of people are expecting that we should begin to see a few new brands. When can we anticipate the impact of that partnership on the brands that your foods business have to offer?
I think we were very clear in our minds that the first few years of this partnership was about fixing our operations and then optimizing those operations and growing the operations. So a lot of the hard lifting right now was around fixing asset care, system improvement, process improvement, upskilling our people, and then capacity deployment. So we are in that space right now. And I think in the next 2-3 years, you will then begin to see new additions. So first of all, we are embedding the business, strengthening the existing core business. And that's what we've also seen in terms of the traction, improvements in our turnover, improvements in our margins, and of course the results which we shared with you for our 2012. And also we're also seeing that still playing through in the first quarter of 2013.
If we can touch briefly the first quarter numbers, a few things jump out for me. The first one, of course, is the depression in gross margins, and I imagine that that's an implication, and that implies the impact of inflation. But what other factors are responsible for that?
We've had some very challenging circumstances around some of our business, largely our ground cereal business. What we saw is that towards the tail end of 2012, there was significant increases in input costs, largely commodity prices, soft commodities like sorghum, maize, soya bean, groundnut. We saw huge increases. So that itself is playing out in terms of margin compression. But I'd just like to say in subsequent quarters going forward, we are taking steps. One, to bring in cheaper raw material offshore, and also some pricing actions have also been taken. So, and I think largely too, with the harvest going to come through, we expect to see moderation in terms of input costs of those raw material. Remember too, this is a situation last year where we had the floods. We also had significant insecurity in the northern part, which is a growing area for most of these grains, and that had impact in terms of input costs. Well, we should see moderation in terms of input costs going forward. We should also see better operating efficiencies, and I think the margins will claw back some of the margins that we lost.
Okay, and a final point will be on other gains. That was a huge boost for profits. We saw the bottom line up about 41%. But other gains of 512 million naira was a key contributor to that. Can you just explain that line for us?
I think it's just the IFRS treatment. Remember that we no longer are under Nigerian GAAP. We're under IFRS. So when you sell investment properties, especially in the real estate business, if these are investment properties you've held, when you have profits on that, you actually treat it as other gains rather than showing it up in your operating profit level. So that's the treatment under IFRS. That's just what